Hello and welcome to BQ Prime. You're watching this special interaction after the RBI notification that came in yesterday to curb risk in unsecured loans segment. I have with me Mr. Harsha Upadhyaya, who is the CIO Equity and President, Kotak Mahindra AMC. He looks at the BFSI funds. Harsha, thank you very much for joining us on BQ Prime. To begin with, what is your assessment? Uh, Post the notification that has come in, and who do you think will be the most impacted because of this?
See, clearly for the last few months, the regulator was pointing out the higher growth that was happening in the unsecured retail credit space. If you look at the overall system growth for the last 2 years on a CAGR basis, we have seen about a 16% growth. And if you look at growth to the unsecured consumer part and the NBFCs, this has grown at about 25-26% CAGR last 2 years. So clearly, this segment had seen higher growth than the overall average system growth. While the growth has been higher and it was being pointed out by the regulator in the past as well, at this point of time, there are no real stress points in this area as well when you look at the whole consumer part. I would say, although the delinquency rates are low at this point of time, this seems more like a proactive step by the regulator to make sure that nothing untoward happens going forward. So clearly, the immediate impact is the unsecured consumer retail growth will come down, and so will be overall credit growth in the system.
Mm-hmm.
So to that extent, already we have a little bit of issues on the net interest margins for most of the financials. Along with that, we will probably also see in the very short term some tapering of growth. In terms of capital adequacy ratios, I think most of them are fairly positioned. So we don't see a big issue in terms of the capital adequacy at this point.
Mm-hmm. What is your assessment with respect to the growth? Because this was some of the NBFCs were growing very aggressively, much about the systemic growth which was happening. And as a result of which now what happens is that there is a additional provisioning that comes into play, and that will eventually have impact on the capital adequacy and as well as the return on equity going forward. So do you see some kind of tapering of growth coming in, and when you speak to your portfolio companies, do they speak about delinquencies coming in, or there is a risk which is coming in because of the personal loan?
As far as we are concerned, we are not seeing any real stress points in the personal loan space as of now, and that's the feedback that we get from most of the financials that we track with as well. However, as I said, the concern for the regulator probably was a faster pace of growth, which was much higher than the system growth that was going into unsecured consumer credit and also to NBFCs. I think that's where they probably thought that it's better to be prudent and increase the risk weights at a point of time when the growth is much higher so that nothing untoward happens later on. So overall, I would say this is a prudent measure, although in the very short term, you will see some impact on growth. And depending on which of the financials are more dependent on the unsecured consumer space, you will see higher impact in that particular set of financials.
Hmm.
But overall, for most of the banks, especially on the private sector side, we would say that capital adequacy ratios are fairly strong, much beyond the levels that are required or mandated by the regulator. So there is no immediate requirement for capital. Yes, growth will come out, probably interest rates will go up for personal loans, and there will be some impact on the return ratios as well. But from a medium to long term perspective, this is a prudent measure, and we don't really see a big negative in terms of growth from a medium term.
Hmm. You know, I was asking this because uh, the risk provisions which have been brought in are not only for new loans but also for existing ones. So as a result of which there is additional provisioning that will start coming in Q3, Q4 onwards for many of these NBFCs. Who do you think are most affected? Some of the NBFCs would be the most affected in that compared to banks.
When we look at our universe of stocks in the banking system, most of the banks are looking at a CET1 incremental ratios going up by 40 basis points to maybe about 90 odd basis points. So, and anyways, they have very good cushion in terms of where they are as per the current levels, and there is no immediate requirement, as I mentioned. As far as the NBFCs are concerned, there are certain NBFCs which are more dependent on banking system for their funds, going up to maybe about 50% of their loan book or borrowing coming from banks. So to that extent, those NBFCs which have a higher dependency on banks for funds will have a bigger impact because one, the risk weights have gone up. So to that extent, the cost of funds will go up, and also there will be tightening of norms by most banks going forward towards this segment. So to that extent, probably NBFCs are a little more impacted as compared to banks at this point.
What about capital requirements for many of the banks and MDC? While banks are adequately provided, do you think many of the NBFCs will now come to this market either in debt, NCDs, or equity to shore up their capital?
It could be on a case-to-case basis, but I don't think it's going to be system-wide that everyone needs capital at this point of time, depending on what incremental growth one is envisaging and what is the current level of CET1 ratio. You will need capital at some point of time. But as I said, most of the banks and financials are well capitalized, so I don't think there is an immediate need for capital raise just because of this particular issue. Yes, the growth itself has been higher, and to that extent, you will need capital at various points of time for financials because that's the raw material that they use. But beyond that, I don't think this particular issue itself will lead to too much of capital raise.
Harsha, you've been watching this space very closely, and you track your portfolio companies very closely there. One of the arguments made was that because bank lending is going to become little expensive, many of the NBFCs which were dependent on banks now will have to move to the capital markets for fundraise, either through bonds or through equity. Will this be the trigger for them to now start looking at capital markets or fundraise, because cost of capital would be much lower from the capital markets as compared to raising it from banks?
Yes, to some extent, yes, they will look at other exposures, and obviously, overall, when you look at the interest rates in the system, I think there is a possibility that it will harden a bit, not meaningfully, but yes, from the levels that we were seeing before the regulations came into force, probably you will see some hardening. So, to that extent, every financial will probably assess and reassess in terms of where to borrow, and how much to borrow.
Finally, Harsha, it's going to be very tricky for both NBFCs and banks going forward. As a whole system, from a system point of view, do you see some moderation coming into the credit offtake as a result of this? Because personal loans were becoming a big chunk of the total credit offtake, which was happening. 15 to 20% of the books of many of the NBFCs were on personal loans. Banks were lending to NBFCs, and banks too also were starting to get into that personal loan space. Do you think that there will be some moderation coming in there?
Yes, to us, it seems like there will be some moderation in the loan growth, especially to unsecured retail consumer part and also to EFCs from the banks. But this is going to be more of a short-term phenomenon. From a medium to long-term perspective, we still believe that our economic growth continues to be resilient and strong. And to that extent, there will be funding needs, and banks and financials will continue to see healthy growth overall from that perspective. Yes, in that very short term, there could be some impact on growth.
Harsha, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you so much.